It's a meaningful concern of the markets, and the concern goes down to global growth. If you get a trade deal, then perhaps you get at least a stabilization of global growth. And that was one of the general reasons why the market sold off so rapidly in November or December.
Will there be a slowdown in U.S. and global economic growth in 2019?
Well, I think the natural pace is for a deceleration of growth in the United States. Our expectation is that GDP comes in around 2.25% to 2.5% overall. And then global GDP, we think there's going to be a pronounced slowdown, and you can get perhaps a 2.7% print, which is far less than the IMF and the OECD's expectations.
That thesis of a global slowdown is probably what played into the sharp drop in stocks that we saw between October and December. But we've seen what looks like, at least for now, a massive V-shaped recovery off of those lows. Did the market overshoot with that pessimism last quarter?
Well, Dominic, I think that they may have done that, but also you had a massive shift of a signal from the Federal Reserve. As financial conditions spiked, the Federal Reserve went towards their third unspoken mandate, which is to do no harm when it comes to the financial system. So they reversed course, and of course, as you saw this week, there's been measured messages from Fed governors about raising interest rates, although we still continue to think it will play a headwind if they continue to reduce their balance sheet.
Do you feel that the lows are in for the market, at least medium term?
I think that perhaps you get a couple more percentage points of gain over the course of the next, say, 12 to 15 trading sessions. But overall, we're in a lower return environment for 2019. Some headwinds, of course, are that the Fed funds rate continues to be about 2.5%. We don't anticipate that they're going to raise interest rates. But that Fed funds rate at 2.5% pretty much is a headwind because our long-term forecasted returns for the S&P 500 is roughly about 5 to 6%.
So then how do you construct a portfolio at Washington Crossing Advisors, given the fact that you think that we are in a low-growth, low-return environment?
So on your bond portfolio, you want to extend your duration at this point and actually start to look towards higher quality bonds, but go out 10 to 15 years on those and the maturities as a buffer. Also, what you want to do is stay in very consistent sectors here in the United States because we are late in the economic cycle. So look at consumer staples. You also want to look at healthcare, and you want to also bookmark that, or actually bookend that, with industrials at this point because they came down so hard.
Is there one place, one asset, one type of sector or industry in the market that is a big tea leaf for you about how the markets in 2019 will react? Is it high yield? Is it emerging markets? Is it currency?
It's definitely EM. EM has been the global driver of growth, i.e. China. And as you start to see a deceleration of growth there, then you see that in the emerging market economies as well as emerging market bonds. So look at China, watch the information information flow there. If you see a huge fiscal stimulus program come out of China, then you want to be more overweight risk at that point in time.